Want to let you know that's supposed to be a joke. Uh, there. Cotton prices remain low after being high. The blue line there is the expired July contract reflecting last year's the 23 crops market. It saw its highs back in the spring, almost made it back to $1, and it took a tumble before expiring. And the red line is what we're dealing with for harvest time prices for the 24 crop. And you can see it didn't get to $1. It got to the mid 80s, and then it's slid down to the lower 70s and pretty much stuck there. There's a speculative reason why we had both of these, the highs and the lows. So it's speculative buying and selling. If you look over here on the very far right end of this chart, there's a green upward peak, which corresponds to a whole bunch of speculative buying back in the spring. And that's what drove the July contract, which is this red line here, up to the peak of near $1. Speculative buying. I'm not sure what was on their mind when they did that, but they were of a bullish mindset and they were trying to profit from it. That's what these speculators reflected by the green areas. That's what they do. They try and guess the trend. So they bet on a rising market and they kind of fulfilled that prophecy, and then they sold. And you can see there's a downward, and we're still in it, a downward pointing uh, green area. That represents a bunch of short sellers. That is, they're outright short. They made a bet that the market was going lower and they sold the market down. So they eliminated this and then they outright did that. And that's why we are where we are. The long and the short of it is speculative buying and selling. Now, I'll point something out with this. This green downward peak here is it's kind of like a coiled spring, in that the people that are represented here, they did this because they thought the market was going lower and that they could profit from it. If something scares them, something bullish like a production shortfall, a downgrading of the expectations of the side of the crop, or a pickup in demand, but more likely a downgrading of the crop if a hurricane hits, or if they cut out, if USDA cuts out, 1.5 million bales because we have our super dry August or something, then these people are going to get scared and they're going to buy themselves out of this position that they're in. So this, even though this is the reason that we have low prices at the moment, we could have a 10-cent rally if these guys get scared by something and and want to buy themselves out. So just keep in mind that we could have some fireworks if, like I say, if these people abandon this position that they're in right now. But they're the practical reason why we still have low prices for the time being. There's fundamental reasons why we have low prices, and that always has to do with what's the expectation for leftovers, for carryover. The more carryover we have, generally prices are weaker. And so this column of numbers here is the supply and demand summary from USDA for the 24 crop, and the carryover is 5.3 million bales of leftovers, which is, if you go back and look at the year before, that's more carryover, more leftovers, more excess supply than what we had for the 23 crop. And that kind of suggests why the 23 crop could get up to $1, but the 24 crop never got that high and is currently fairly weighted down. It's fundamentally, it makes sense that it should be weighted down because the market is anticipating more production. Here's a 17 million bale crop, which USDA is currently forecasting. A 17 million bale crop, and we're going to export 13 million of that. But we're increasing the amount that's left over because the increase on the production side is outweighing the increase on the consumption side. So there's a lot of moving parts in the supply and demand breakdown, so let me just spend a few minutes talking about it. First of all, the size of the crop is largely a function of the acres planted. That black dot right in the middle of this chart with the 24 by it, that's the number of acres planted. It's 11.67 million acres planted. It coincides very closely with what an economist would have expected based on the relative prices of competing crops with cotton. This chart shows the ratio of corn prices to cotton prices, which would have predicted that we would have been right in this range of 11 to 12 million planted. In fact, we were, at least until they revise it, which they might. But anyway, if we plant 11.67 million, everything else is driven off the expected abandonment and expected yield. And the weather's been pretty decent. We came out of the El Nino pattern, which is a wetter pattern, and we're in a normal climate diagnosis at the moment. But we've been having a wetter than normal year over most of Texas, except the exception of the Winter Garden and where my brother's deer lease is down here in the red zone. Everything else is relatively clear, especially for July. It's been raining a lot in the Delta. It's been raining a bunch, and then it's come off dry over here in the southeast. So other parts of the country are having their issues. But all in all, I'd say we're having a pretty good summer. We dodged a hurricane. It did as minimal amount of damage to mature cotton as we could have expected coming in at Victoria and going north and east from that point. And we had plenty of rain in the middle part of the state, from east central Texas all the way over here to the rolling plains, and it's been raining on the high plains off and on. So we'll have to see how it plays out. But right now, I'd say that the expectation of a 17 million bale crop isn't too outlandish. It's not too far off. It could always change, though. We could have a severe hot and dry August. We could have a damaging hurricane land, and like I say, if something like that happens that lowers the expectations of a 17 million bale crop, then all those speculators are going to buy back their short positions, and we could have a little quick 10-cent flurry in this market that would take us to the low 80s, which probably isn't enough to cover production costs, but it's better than the low 70s. But yeah, we'll have to see. In terms of demand, I show this chart a lot, which basically just says that cotton consumption goes up when we're in a boom time. It goes down when we're in a recession. There's some notable historical recessions. Cotton consumption is this blue line, which dips every time we're in a recession. We're not officially predicted to be in a recession, but the people that predict these things are saying that we're in a low, slow growth forecast. And low, slow growth just suggests to me that we're not going to get much lift from the demand side of the cotton market. So again, if we have a decent crop and not much improvement on the demand side, I expect us to have more carryover stocks, and it explains the weaker prices that we're seeing. People are guessing about what the Federal Reserve is going to do. Are they through raising interest rates? Probably through. Are they ready to start cutting interest rates? Well, I've been hearing that now for 6 months, and it seems to be differences of opinion. And meanwhile, inflation is still above the target level of 2%. So I would say we're still sort of in a headwind in terms of the macroeconomic picture and the influence on the overall economy, and therefore the influence on cotton demand. I'd say we're in a headwind situation. We're not in a bullish situation. I'll say that much. Other kind of big picture black swan things that I would point my grower audiences to think about, and I'll say we should be thinking about them, is if first of all, if the markets expect a second Trump administration, that right there may be a reason why things are a little bit weaker, not so much on the general economy side of things, but in that a Trump administration might bring about more tariffs. And from an agricultural trade standpoint, tariffs are not good. I'll remind everybody the last time we had tariffs during the first Trump administration, we slapped selective tariffs on Chinese imports. The Chinese reacted by slapping tariffs on U.S. selected imports into China, namely soybeans and cotton, and that really disrupted the cotton market. And if it happens again, I expect disruption. And I hope we don't have, Mexico's a major trade partner, so I hope we don't tie immigration to tariffs and trade policy either. So we'll just have to see what this means in terms of the impact on the cotton market. But to me, I'm cautious. I'm cautious. So I'll just wind it up again. I think we're planting 11 plus million. I think I would expect, average to slightly above average abandonment. That's what USDA is currently expecting, and average yields. And that could give us, I'd say, without too much trouble, could give us a 17 million bale crop. And if demand doesn't balance that out, which I'm not expecting it to do in a strong sort of way, then I think we'll have more ending stocks. And I think it explains the weaker prices that we have, with the caveat that the buildup of short speculators that we currently have could act like a spring if they get scared of more bullish developments and buy themselves out of the market. That could give us some fireworks. I don't know that would give us 80-cent prices at harvest time, but it might give us a rally to the 80s here during the middle of the growing season, sometime before the summers or before harvest is out. The red line is prices where they are, the December contract. You can see we've taken our normal seasonal pattern is to have weaker prices in July and August and into the harvest period. We've already followed that seasonal pattern. I think there is a chance for some fireworks, but I think we'll probably settle back into this lower prices for harvest time. And that's where I'll leave it, Pancho. So I'm going to end my slideshow and end it off. Stop sharing. There we go.
Hey, thank you very much, John. Any questions for John? Mark, do you want to get your
You bet, Pancho. Let me see if I can get this up and running where everybody can see it. I hope we're okay there.
Yes.
Great to be with y'all this morning. Have a chance to talk about what's going on in the grain markets. We're, of course, wrapping up the 24 wheat crop, and Central Texas and South, we've got pretty well mature sorghum and corn crops. Ways to go certainly up in rolling plains and high plains. But I'm going to follow much of the format that Dr. Robinson laid out. Many of those same factors, of course, that you'll see in the cotton market influencing what's going on in the grain markets as well. And I'm going to start out with just where prices are trading currently. Those represent cash Texas prices for wheat, corn, and grain sorghum, kind of where we've fallen off from their peaks, after the Russian invasion in February of 2022. And we're back to those levels of the late summer and fall of 2020. And there's a fundamental reason why. And we'll kind of talk about that and perhaps some of the prospects where we may be moving forward. As we've wrapped up the 24 winter wheat crop, one thing that was notable, if you look at the USDA condition ratings that come out every Monday afternoon, the green dotted line would be what an average index would be of the share of crop that's rated very poor and fair and good and excellent. Through the spring, we mostly had crop condition ratings that were above normal. Dipped a little bit in early April with some concern over drought and freeze, particularly in Kansas. But then we ended the season on a pretty strong note in terms of seeing an improvement in those ratings. And the blue dotted line is the 2023 crop. And so we had better condition ratings, of course, throughout the season compared to 2023. But generally speaking, especially late in the season, better ratings than normal. And that's given us then some yield prospects. USDA revised the winter wheat yield upwards in the July crop production report, now looking at a 52 bushel average for the U.S. winter wheat crop. Not a record. That was back in 2016. but above what would be a trend-lined yield projection of just over 50 bushels. So certainly a strong winter wheat yield performance here for 2024. And then if we look at the condition rating currently of the spring wheat crop, the top portion of this chart from USDA is the share of crop that's rated good and excellent. And this is over the last 5 seasons. In 2021, at this point in the season, we were looking at less than 20% good and excellent. This last week, we're almost 80% good and excellent. So over the last 5 years, by this measure, this is the best that this spring wheat crop has looked compared to these other years. And you look at the yields associated with those crop ratings from a 32.6 bushel yield up to 46. We set the previous record when we were trading up in this area at the 48.6 bushels, and USDA's current projection for the spring wheat crop, a 53.1 bushel yield, which would be an all-time record high. So we're certainly seeing an environment of much better wheat growing conditions for the winter wheat crop and carrying over into the spring wheat crop. Much has been of concern of late in April and May of what was happening in Russia. They had many of the same condition concerns that we saw in Kansas. We had a stretch of dry weather. We had some freezing temperatures at a growing point in the wheat crop that would be very sensitive to freezes, and so there's still some concern until we get that Russian wheat crop in the bin. We're really not going to nail down these production numbers. But if you compare to the last marketing year, smaller crop in Russia, smaller crop in Ukraine, and they had some of the same weather-related issues, but of course the conflict there continues to impede agricultural production in general in Ukrainian agriculture. But look where we've made up the difference. Yes, a smaller crop in Europe, smaller crop in Russia, smaller crops in Ukraine, record crops in China, record crops in India, rebound here in the U.S., coming back stronger in Canada. Australia has some really good crops the last 4 or 5 years, but back above last year. Argentina's up. Kazakhstan, a major wheat producer of the nations of the former Soviet Union. So we just add up these major contributors, and we're adding 244 million bushels to the world wheat supply. And again, in 2024, an all-time record high wheat crop, even given the concerns and the issues that we've got in major growing areas of Russia and Ukraine. So again, with wheat being produced in so many places, it's a much more diverse production environment, and we're seeing the ability to compensate for some significant losses in a major production area like Russia. If you look at the stocks to use ratio for world wheat, and the number I like to use is days of use on hand at the end of the marketing year. How long can we live next year on the crop that was left over last year? And here in the U.S., again, with the strong production prospects here for 2024, we're looking at increasing that carryover by almost a 19-day supply. Significantly higher the last couple of marketing years. We've been in a significant downward trend. The last 4 or 5 years, that stocks to use ratio, that days of use on hand, getting tighter and tighter and tighter. Here in the U.S., not as tight, going back to those previously record high prices of 2007, 2008. But yet certainly a trend higher, some concern, but now we rebounded that significantly. But keep in mind that the U.S. wheat supply accounts for about 6% of the global total. If you look at the world stocks to use ratio, world days of use on hand, it is still relatively tight. Now, including China in the mix, we're about where we were in 2014-15. Take out China, where numbers were revised significantly higher back in 14-15, and given that China doesn't trade a lot of wheat, what would the world look like just taking China from the calculation of this particular measure? And we've still got the tightest global world wheat supplies without China going back to 2007, 2008. So it is a condition that we could see volatility return to the wheat market very, very quickly, where there is a significant production or export market availability issue because of war, because of weather, because of trade disputes in any major production region. So the global situation is still relatively tight, even though are seeing some relaxing of supply concerns here in the U.S. Revising that supply and demand table for wheat, given the higher yield numbers now that USDA is plugging in for the wheat crop. Our planted acres are down, harvested acres are up. We've got a better conditions for putting a combine out on a wheat field. So an increase in our harvested acres, combine that with a higher yield, we've got a 12% higher supply. Yeah, we're increasing U.S. use to some degree. Feed use is up, exports are up, but we just can't keep up with that increase in supply, and that's giving us that downward pressure on prices, where we're increasing use only 8%, when we increase supply by 12%. And that's putting that downward pressure on price. And what that looks like relative to the season average farm price related to that days of use on hand measure, certainly as that days of use hand goes up, that puts downward pressure on prices. And that's pretty well the trend that we're seeing in the wheat market here for 22, down to 23, and then down into 2024. The seasonal pattern of wheat prices, typically we see a little price rally in February and maybe some other pricing opportunities in late April and May. This year's wheat price, we traded steadily downward and actually hit our harvest time, or excuse me, our harvest contract low in late February. At the time, we should have been hitting a midwinter and early spring contract high. We finally did get a price rally based on those concerns we were just talking about of drought and freeze, which kind of set us back on that seasonal pattern. And then we kind of closed out about what you'd expect for the wheat market at that point. Looking ahead of where we may go, this is just an index of average wheat prices. There may be some yet, if we get a little rally here in late July, early August, an opportunity to price some wheat. Typically, however, we do go lower from early August into that November, December time period. Again, if weather concerns, here's our typical price rally in February. Again, the pricing opportunity in April and May before we go down and set a lowered harvest. So if I'm putting my marketing plan together for this 2025 wheat crop, these are certainly the price tendencies that I would build into my marketing plan expectations. Certainly an influence on winter wheat has been a good one coming out of the El Nino winter that we've had, a relatively strong El Nino with temperature deviations of 2 degrees above normal out in the eastern Pacific. That has waned to this point, and as John mentioned, we're now in the neutral zone of that La Nina El Nino cycle, with the forecast to enter back into La Nina conditions later this fall and early winter. And that typically would mean a drier and warmer environment for the winter wheat crop that we would be putting in this fall, which would be not conducive to the U.S. winter wheat crop. However, at this point, that La Nina pattern appears to be relatively shallow and relatively short-lived. And so perhaps that would lessen the negative impact when it comes to our expectations for winter wheat production in 2025. Crop condition ratings, critical what's going on in the corn market. Again, the blue dot would be what an average condition rating would look like going back over the last 40 years. And the black line is an index created for the 2024 crop. We're trading with some 70% of the crop in a good to excellent category, and those condition ratings slightly above normal. Let's zoom in on those and look a little more closely, comparing what's going on this year in 2024 relative to average, relative then to the 23 crop. In 2023, we saw conditions significantly worse, particularly at this time in the growing season, compared to where they are now, where we're actually condition ratings above normal. And with those condition ratings last year, we still ended up with an all-time record high corn yield of 177.3 bushels per acre. A trend line yield in 2024 would be about 181 bushels per acre. And at this point, we are trading on conditions that would seem to be supportive of a trend line yield for the 2024 corn crop. The drought coverage in the Corn Belt, this is the north central region. Look at that drought map in 2024 on the left side compared to the drought map of where we were a year ago. Again, in late July, we were at the silking and tasseling stage for much of the critical growing areas, the major growing areas in the Corn Belt. So they're sensitive to temperature, sensitive to heat. As we're setting our yield potential for this crop, a year ago, 81% of that north central region was under some degree of a drought alert. And here in 2024, we're looking at 16%, with the areas of concern way out here in primarily out in eastern Ohio. And again, that's not prime corn growing area. The corn is over here in the northwestern corner, and then of course in the western parts of the Dakotas and parts of Kansas, where we see the drought conditions still kind of popping up. But a much different situation this year compared to a year ago. And again, remember, in this map on 2023, we set an all-time record high corn yield with those kind of conditions. And so I think why we're seeing the price response to what is a much more favorable growing environment for U.S. corn here in 2024. USDA revised the supply and demand tables. We're still sticking with 181 bushel yield. We have lowered acres by 3 million acres compared to a year ago. We are looking at a slightly smaller corn crop compared to a year ago, but with higher carryover levels, we're still looking at an all-time record corn supply as we begin the new marketing year. And again, this is the challenge for us, is we're increasing that supply level relative to the degree that we're increasing use. Domestic use is higher. That'd be an all-time record high. Domestic use, exports were revised higher for old crop corn, holding those pretty well steady for 2024, and still just not keeping up on the demand side with the potential of a larger crop on adding to the corn supply. And again, that's the recipe for downward prices. What that looks like in the same chart we were looking at for wheat. Here's your season average farm price for corn going back to 2005, 2006, relative to that carryover, the days of use on hand at the end of the marketing year. In the corn market, watch the number 40. When you get that supply below 40, that's when we see those opportunities for significantly higher corn prices. You get on the right-hand side of that, 40 and plus, now we're into the more price-depressing supply to use statistics that are negative for our corn prices. And the current estimate for that 24 crop would be right in line with what that relationship would suggest since the beginning of the biofuel era in 2005, 2006. The global corn situation is responding a little more positively than we are for wheat. The U.S. number is coming up. World less China, down a little bit in the current marketing year, but higher than the last several years. And including China in the mix, we're still up just a little bit. So we're certainly stabilizing from some supply concerns that we had in the corn market going back to just a couple of years ago. So we're starting to turn that number around. And as compared to the wheat market, where the U.S. only composes about 6% of production, now to the corn market, we're looking at 30 to 40%. The U.S. is still the largest producer. We're the largest user. We're the largest exporter. We are still the dominant force when it comes to the world corn market. Looking at seasonal price pattern tendencies, the 24 futures are following very closely to what we saw in 2014. We set a contract high early that year in April and May. Typically, we'd do that over here in June. So we set the contract high early, fell off hard in the summer. And why did we fall off like this? Strong crop condition ratings. In 2014, the share of crop rated good and excellent never dropped below 72%. We had good crop ratings all the way through. Are we going to see that for the rest of 2024? I don't know. There may be some question over the next few weeks of what those crop condition ratings do. If they do hold strong, I would expect then another leg down on these prices, barring some other global or event or something on the demand side. Again, setting the harvest low, typically late September, early October. And then we get some kind of, generally a moderate kind of a post-harvest kind of bounce. We overdo it at harvest time with downward pressures. So those are the kind of features we're seeing in the corn market. The challenges across the markets, whether you're talking about sorghum or soybeans or corn or wheat, that in this current growing environment and current economic environment, the factors of supply increasing faster than the factors and greater than the factors of demand. But it's a weather market. As we, wheat wrapped up the year with pretty strong production numbers. We'll see how we end up with corn and sorghum. But at this point, things look like to finish on a very strong note. Appreciate being with y'all today. I will stop sharing that screen and certainly be glad to continue the conversation, any questions or discussions that come up later on.
Thank you, Mark. Appreciate it. Is there no question from Mark? David, if you want to start your presentation.
All right. Honcho, see that good?
Yes.
Great. Well, I figured I'd just kind of title this thing right after the cattle on feed report that came out late Friday afternoon. And I want to talk a little bit about number of heifers on feed and some implications for that. Listening to Mark's presentation, I was asked by a reporter last week about kind of overall conditions in agriculture in the U.S. And, oftentimes this is sort of a teeter-totter or seesaw type of effect, with these really low corn prices, soybean feed prices. I mean, that's our feed for livestock. And I think we really see the effect on calf prices, some of the feeder pig prices in those markets, things like that, even on the feeder lamb side too. Really, there's an effect from these corn prices. And so, I think that's a big part. While we can talk about tighter supplies and things like that, that's boosting our market. The extra part is really coming from the corn side. And so you think about overall conditions in agriculture, we've got some pretty tough prices on the crop side, being offset by certainly good prices on the calf market side, and some improving prices on stuff like dairy and some other things. So that just kind of struck me listening to Mark that to remind ourselves of that, some of those conditions and what corn's doing on the livestock side. The cattle on feed report came out Friday afternoon. The big headline number, cattle on feed, we're about a half a percent more cattle on feed on July 1 than a year ago. So, really declining seasonally, but we continue to have a few more cattle on feed than a year ago. I'll come back to this. I'm going to show you the marketings number because I think there's some interesting kind of technical data type things going on this year that really make these numbers bounce around a little more. I think, and so I want to talk about that. But really, the overall picture is, declining numbers seasonally, but still ahead of a year ago for another month. And so we think about beef supplies. That's a bunch of cattle on feed still. So, I think that's the first part out of that report that's worth noting. The next part is I'll use the number of heifers on feed. Every quarter, we get a breakdown of all those cattle on feed, how many are steers and how many are heifers. We continue to see a large percent of cattle on feed that are heifers. As steer numbers have come down, as our cow herd has come down, we've been placing a larger percent of our heifers, and this showed the same thing. In fact, while it's close to 40% of the total number of cattle on feed, we actually had 5,000 more heifers on feed on July 1 compared to July 1 of a year ago. Now, 5,000 head is not much. That's a pretty small number, but the fact that it's still ahead, I think is pretty significant. And so, as we think about looking for some evidence in the statistical data on herd rebuilding, have we moved any way closer to some herd rebuilding? It's not a lot of evidence for it there. Now, I do think one of the interesting things is this: it's heifers on feed. So I get a lot of questions about beef on dairy and using beef bulls on the dairy side to produce those beef dairy cross calves. One of the things we might consider is that we may have a few more of those animals in this heifer herd that's on feed. And so, that could be maybe skewing our data a little bit compared to the past. But, if you start digging through the numbers, there's likely not enough of those to change this basic idea to one of really no evidence of herd rebuilding, to change it to where we've got rebuilding going on. And so, you know, that might be a question. Are we seeing more heifers coming from the dairy side into feedlots because they are these beef dairy crosses? That could be, and it could show up in the data, but it's likely not enough to change this to a rebuilding type scenario yet. If we dig through the data, I thought one of the things that was interesting in the state level breakdowns, we actually had Kansas actually had 130,000 fewer heifers on feed. The states that were up significantly in heifers on feed are Texas, Oklahoma, and Colorado, and so and for that matter, Idaho as well. So there are some state kind of level differences for what that's worth, but still overall that's a lot of heifers on feed, and we didn't get any evidence, I don't think, in the cattle on feed report of any kind of move to rebuilding. The other part, I thought I'd use two slides here. I wanted to pull out something out of the marketings. Marketings were down over 9% compared to a year ago. So you can see this blue line, you see a pretty sharp decline, whereas normally, marketings are going up in these summer months. Well, take a look at what happened in June of this year to marketings. Marketings were quite a bit lower. But really, it's actually sort of a statistical interesting thing in the data this year. And that is, as we look at this, we look a lot of times at the number of what we call slaughter days in the month. And that's really our working days. So we could think about that as really Monday through Friday, and we're talking packing plants here. And we might consider Saturday as being a half a day, where, that's traditionally how we kind of do the data. So what happens is if the way the week falls, either you get a holiday or you get an extra weekend, just how the dates happen, you can get some as much as 2-day swings in that data. It turns out that in June of this year, we actually had 2 fewer days compared to June of last year. That doesn't happen very often. We had the same thing going on between March, April, and May, which generated some interesting swings in the data that are really day dependent. And we got to go back to the mid 1990s to have those 2-day swings like that earlier in the year. But what that means is, if you think about 2 less days, that pretty much takes care of that over 9% decline. And if we're looking at daily average marketing, so we take the number of total marketings divided by those days, heck, we're actually just a touch ahead of a year ago. And so what that should tell us, though, is we think about, well, gosh, you'll see in the popular press, are meat packers slowing down? Are they pulling back on production to try to boost the cutout or reduce fed cattle prices? Well, gosh, if we look at marketings out of feedlots, we're right there on about the same path as a year ago, with continuing to move cattle at about the same rate. And so it really, that big decline really reflects those day lengths. And I think that may be something we hear talked about is, gosh, marketings are down. This is, are we seeing some efforts to slow down? Well, gosh, if we take a look at the days, not a whole lot of difference in those slaughter days. So I think that's something interesting to kind of pull out and kind of keep in your mind as maybe we see some of the more, popular press reports or whatever about this. I think that'll show up. One of the things that has driven beef production this year is as we look at the number of fed cattle going to market, steers and heifers, we've basically been, the amount of fed beef production has actually been a touch ahead of a year ago. So we've actually been producing more fed beef production. All the decline in beef production is really coming from the cull cow side, where we see double-digit declines in both beef and dairy cow slaughter. That's the only part that's holding down beef production. But weights have been a big part of this. If we look at where weights have been, these are dressed weights so far this year, well ahead of a year ago, even really bucking against that normal seasonal decline in weights that we typically see through about really back through June, and then weights begin to increase. We did see a little bit of a decline in the last month or so in weights, but well above a year ago and continuing to support that beef production. One of the things I expect to see on weights is as we go through the year, I do expect to see that kind of gap narrow up to a year ago for a couple of reasons. I do think we're going to see fewer cattle on feed as we get later in the year, really pulling down that number of cattle on feed more than 120 days. Part of these heavy weights is due to cattle being on feed longer and a lot of pretty good weather. But over the last month or so, we've certainly had some pretty hot weather in the plains. Hot and humid conditions that has probably pulled down weights a little bit, but also as we move these cattle through feedlots, we're seeing some declines in the number of days on feed. And so I think that's helped, that has the potential to help moderate some beef production a little bit. But still, big story is, shoot, man, those dress weights have been historically very large and kind of counter seasonally moving as well. And so we'll see what happens later in the year, but I think weights will continue to be one of those interesting points going forward. And if we look at total beef production, we've had some weeks, particularly back in April, where total beef production was well above where we were the year before. Really driven by weights, even so our fed beef production has been about the same as a year ago, and the real decline is on the cull cow side. I'm really watching for some declining beef production later in the year as we pull down those fed cattle numbers. But we're already into July, and so those effects on beef production, if they're going to really be coming, we continue to have the same number of cattle on feed. So that's pushed out further and further in the year. A couple things on prices. I just thought I'd show a pretty simple 500 to 600 pound number one steer calf prices. We continue to see prices running above a year ago, supported by Mark's corn market. I think that's certainly adding some to these prices. Prices well above a year ago as well. And I expect those prices are going to continue to run above a year ago this year. And, I fully expect next year's prices to be higher than this year's. And so, as we go forward, we're going to continue to see these higher prices as we get some tighter supplies. And if we look back to that cattle on feed number and heifers on feed, that doesn't suggest that we've really started much rebuilding yet. So again, it pushes out this time of higher prices further because we've really delayed any kind of much expansion. So heck, these prices are going to be with us for a while. If I look at fed steer prices, just out of completeness, Southern Plains, so this is Texas, Oklahoma, we've dropped back into the 180s over the last 2 weeks, got over 190. One of the things, if you follow these markets fairly closely, you'll see that we continue to have a relatively large price spread between Northern Plains and Southern Plains. We almost hit $2 for weekly averages, so we were a good $8 or $9 higher in Northern Plains to Northern Plains feedlots versus Southern Plains. That gap is still in that range on the steer side too. So, but price is still ahead of a year ago, and even with beef production where it is, these are pretty high prices given same level of beef production as a year ago. So again, that's pretty positive news on the cattle side, and I think that's going to continue. I want to hit a couple of other markets. Lamb, We got the lamb import data for May. There's about a 2-month lag in this data. So I thought I'd show imports. We continue to see more imports coming in compared to a year ago. Exchange rates aren't helping that. We've also had a fairly wide gap between if we looked at U.S. domestic legs versus Australian legs or New Zealand legs, we've had a pretty wide gap there, and that's encouraging some more imports. We've had some higher prices for lamb in across our markets, and that's encouraged some more imports as well. So imports are really responding to that, to kind of those price signals. And if I looked at domestic production weekly, it's pretty easy to see in the weeks leading up to Easter, which was at the end of March this year. We produced more lamb domestically. It dropped off seasonally as it usually does, but we continue to have had weeks with more production than a year ago. So if you add up all this production, I came up with we are almost exactly the same amount of lamb and mutton production as a year ago. It was actually a touch higher on lamb production. So if you add just a touch more production and more imports, we're actually trying to sell more lamb in the domestic market than we did a year ago, and we've got prices that are better than they were last year. And so that's a bit of a success story so far, that we've been able to move greater supplies at higher prices. Now, if we looked at the cold storage data, that's starting to grow a little bit. So it does imply some of that production's going into cold storage, but we've managed to do this with higher prices. So I think that's pretty positive on the lamb side of things. If any of you follow milk, we've certainly had some milk prices that have been pretty terrible for quite a while. And you may notice that in some of the data that we have really worked on that industry side to hold back production, to whether it's production per cow declining, total production really holding back because of these disastrously low prices. So what I wanted to highlight is this rebound in milk prices. And I'm using the Class 3 Federal Milk Marketing Order price. The Class 3 price is really related to the cheese market. And what we've seen is a dramatic recovery in cheese prices, shows up directly in the Class 3 prices as well. If we looked at Class 4, those prices have rebounded pretty sharply as well. So our all milk price has gone up too. But really, look, this is pretty striking change of fortune on the milk side. And I just thought it'd be useful if any of you do have dairies in your county or got some milk stuff going on. We've certainly seen a rebound in prices. That gets us to $20 per hundredweight. The Class 4 price would imply an even higher price for Class 4 milk, but we got a pretty sharp increase going on. It's a movement in the right direction for on the dairy farm side. And I'm going to close with two quick slides on a market that we don't produce a lot of, but we are getting to where pretty close to when I start getting a couple of phone calls about what's going on for turkeys for Thanksgiving. and it might be too early and too dang hot outside to think about this, but I'll come back to this later in another couple of months, but I thought I'd throw this out now in case you see some questions or comments about it. We've been producing less turkey this year than last year. And it really relates to, I would argue, profitability. And I'm going to show that. So if we look at production here, monthly production, we've certainly been below a year ago. But if we look at these turkey prices, these are whole hen, wholesale market, 8 to 16 pound birds. You take a look at where prices are, those are pretty disastrously low on the production side. And so even with Mark's cheap corn, I think the turkey market's really struggling, and these low prices are reflected in this tighter and tighter production. So on the production side, we're not producing as many. If we looked at the cold storage data, we got a little more turkey in storage than we did a year ago, which suggests that, supplies we're going to have plenty of turkeys, but this tighter and tighter production really reflects these very low prices. And so And you can certainly see that collapse really happened last year. I'll say, one other thing for another market. I think last month I used the number of egg laying chickens that we have. As we continue to see outbreaks of HPAI on some pretty big layer operations. Tomorrow, USDA's chicken and egg report comes out, and we'll get a look at how many, kind of some effects of that on our egg laying population. As those are likely pulling those numbers down, we'll see a rate of replacement. And we're going to, we'll start seeing what's the next month's worth of effects on that egg market. In the wholesale market, we don't have higher egg prices yet, but we're not at a huge demand period, I don't think. And so the effects of HPAI on the egg side, I think we'll keep seeing, and we may talk about that some more, maybe next month or a month after, particularly as we get to the holidays. So that's my last slide. Let me end the show. Stop sharing. I think I stopped sharing. Nope. Now we got it. Y'all got any questions for me?